All right, let's get to work. Today, we are breaking down the full life cycle of the covered call strategy. Look, this isn't just some fancy tactic. This is the go-to income generator for any serious portfolio, and we're going to walk through it step by step from start to finish. We've broken this down into 5 key parts. Think of it as a journey, right? First, we build the foundation with the covered requirement. Then, we get into the action, selling to open, and the strategy behind choosing your strike. From there, we'll get ready for the 2 possible outcomes. And finally, we'll learn how to take control by mastering the exit. Let's dive in.
Everything starts right here. Before you even look at an option chain, you have to understand the covered part of a covered call. And let me be clear, this part is non-negotiable. It's what keeps this strategy smart, not just speculative.
Okay, let's talk numbers. The magic number here is 100. See, one options contract, it controls 100 shares of stock. So if you want to sell one call contract, you absolutely have to own at least 100 shares of that stock first. Period. No shortcuts, no exceptions. That's your ticket to the game. So what are those 100 shares for? Well, they're your collateral. They are the cover in covered call. When you sell that option, you're making a promise, an obligation, to sell your shares at a specific price. Because you own them, you can back up that promise. Without them, you're selling what's called a naked call. And trust me, that's a gamble with potentially unlimited risk. But with those shares in hand, your risk is totally defined and under control.
All right, so you've got your shares. They're just sitting in your account. Now comes the fun part. We're going to make that asset work for you. This is where you actively start generating an income stream from the stock you already own.
And the process itself, it's surprisingly simple, really. First, you lay down the terms. You pick a strike price, that's the price you'd be happy to sell your shares for, and an expiration date. Second, you place what's called a sell to open order. That just tells the market you're creating a new contract. And third, and this is the best part, you instantly get paid. A cash premium lands right in your account.
I mean, the second that trade goes through, boom, that premium is in your account. It's cash, and it's yours to keep, no matter what happens next. I want you to think about it this way. Say you bought your stock for $100 a share. If you collect a $2 premium, what's your real cost now? It's $98. You've just immediately lowered your cost basis. That's a real, tangible return on your investment right away.
Okay, this is where the real strategy comes in. The art of it, if you will. Choosing your strike price. This one decision is a balancing act, It's going to directly impact how much income you make and also the odds of you actually keeping your shares.
All right, let's look at a real example here. Here's an option chain. Let's say the stock is trading right at $100. Now, since we're selling a call, we're looking at the bid price. That's what the market is willing to pay us right now. And typically, you're going to be looking at out-of-the-money strikes, so prices that are above the current stock price. See that 105 strike? The bid is $1.50. Remember, one contract is 100 shares, so that's $150 of instant cash. Or you could go further out to the 110 strike. The premium's a bit lower at 80 cents, which means $80 in your pocket.
So, which one do you pick? Which strike is best? And the honest answer is there's no single right choice. It's a trade-off. That 105 strike, it pays you more right now, a nice 150. But because it's closer to the stock's current price, there's a higher chance your shares will get, well, called away. The 110 strike, on the other hand, pays less, only $80, but it gives the stock more room to breathe. So the question you have to ask yourself is, what's my main goal here? Am I trying to get the most cash in my pocket right now, or am I more focused on holding on to this stock for the long haul? All right, so you've sold the call, you've collected the cash. Now what? Now you wait. And when that expiration date arrives, only one of 2 things can happen. That's it. There are no surprises. Let's walk through both scenarios so you know exactly what to expect. Okay, scenario 1. This is what you're usually hoping for. The stock price finishes below your strike price. Perfect. The option you sold just expires completely worthless. Your obligation to sell, it just vanishes. You keep the entire premium and, most importantly, you keep all 100 of your shares. You're now free to turn around and do it all over again. Now scenario 2. The stock closes above your strike. This is not a bad thing. Your obligation kicks in and you sell your 100 shares at that higher strike price. You still keep every penny of the premium you collected, plus you lock in all the profit from the stock moving up to that strike. It's a clean, successful trade. You take your capital and move on to the next opportunity. But wait a minute.
What if the stock is on a tear, it's flying up, and you suddenly think, man, I don't want to sell this stock anymore? Do you just have to sit there and watch it go? Absolutely not. You are not a passive spectator here. You can take action and manage the trade before it expires. This is how you stay in the driver's seat.
The tool you use is called a buy-to-close order. It's exactly what it sounds like. It's the mere opposite of the sell-to-open order we started with. Instead of selling to create a contract, you are now buying that same contract back from the market. The moment you do that, your position is closed and your obligation to sell your shares is gone. Poof, canceled.
So why would you do this? Well, the main reason is that your opinion on the stock has changed. Maybe you think it's about to break out and go much, much higher. By buying back that call, and you might do it for a small profit or even a small loss on the option trade itself, you free up your shares. You get them back unencumbered, ready to ride that bigger wave up. It puts the ultimate control over your stock right back in your hands.
And really, that sums up the entire philosophy here, doesn't it? When you master this cycle, you fundamentally change your relationship with your investments. You own the asset, the stock, and you stop just hoping it goes up. You start generating a consistent yield. You're literally collecting rent on your shares. You're the one setting the terms. You stop being a spectator in the market, and you start being the house.